A lot of people are making a huge mistake with their money right now, and you may think that this doesn't apply to you because you're like, well, I'm not an investor. But if you have money that is put away in a 401k, an RRSP, a TFSA, if you are investing for retirement, then you are exposed to the stock market. And right now, the stock market is at record highs. I've made a ton of money. My accounts are sitting at almost $6.1 million. And the Fed, they make their rate cut decision this week. And a lot of people are celebrating because the stock market's been going up, 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 up. But wealthy investors know that there's something else you should be paying attention to. They are doing something called rebalancing. And if you don't know what that means, then you are essentially gambling with your money. So let's take it back a little bit. The Fed is the US central bank, okay? They're basically like the thermostat for money and the economy. When they raise rates, your mortgage, your credit cards, your car loan, like that all gets more expensive. When they cut, borrowing gets cheaper, and they do this with the intention to see the economy expand. That's why the markets are going crazy right now. But what you need to understand is that hype is not a strategy, and you need to be rebalancing. And basically what that means is just making sure that your portfolio has not drifted out of balance. I want you to think of your stock portfolio like a big plate, okay? We don't want to see 80% carbs on that plate and only 20% protein. That's not a balanced meal. Essentially, what you're looking at is something called your asset allocation. So let's say you are 30 years old. A sample allocation may look like 60% of the total US market, okay? And then maybe 30% international stocks and 10% bonds. What happens over time is certain allocations or certain percentages of different investments in your portfolio can surpass the level that you wanted them to be. So maybe if the US market's doing really well, instead of having a 60% allocation to US, maybe that goes up to 80%. And suddenly maybe you're taking on more risk than you had planned for. Or even worse, if you're somebody who invests in individual stocks, and I see this all of the time with my students who come into my program, they have a single stock that's eating up like 60% of their portfolio. And while things are going well, they're hyped, it's going up, they're feeling really good. But then when the market crashes, because a crash is always around the corner, okay, they happen on average once every 2 years, they lose years of progress, and sometimes individual stocks don't recover. So what I want you to do today is go to your investing app. I want you to log in. I want you to go and look at your holdings or allocations. Write down all of the percentages and then compare that to what you actually want in your portfolio. Has anything surpassed where it is supposed to be? If so, you need to trim it, which means selling some and reallocating that to other parts of your portfolio. That is how you protect your gains, because making money is great, but not losing it is even better. Now, if you have ever felt like investing is confusing, this is just one of the things that I teach my students, and I'm doing a full breakdown of the 5 steps that you need to take to go from broke to millionaire in my new free training. It's only available for a limited time, so go and grab your spot right now before it's gone. Link in bio.